What's up guys, and welcome back to the channel. It's been a few weeks since I last posted any videos, but today I have a special video talking about some very good opportunities right now in the EV market. EV stocks have been having a good month overall, but each of these has serious upside potential in both the short and medium terms. So before we get into it, if you like the content, help me grow this channel, smash the like button and drop a comment. Small channels like this only grow if the videos are getting likes and comments, so let me know what you think of each of these stocks. I would really appreciate if you could help me get to 300 likes on this video. Let's make it happen. Subscribe to the channel if you're new and hit the bell notification so you never miss a video with the potential to make you money. I want to point out that I'm not a financial advisor and this is not financial advice. Now let's get into it. The first EV company is Polestar. This stock is currently trading at $9.73 and is a company that I have talked about on many times. Polestar is a global pure-play premium electric vehicle company based in Sweden, with a mission to produce progressive electric performance cars designed and engineered without compromise. They say they are a design-focused electric performance car brand, harnessing refined performance and cutting-edge technology. The company was originally founded in 1996 as a racing company and developed a partnership with Volvo, before being acquired by the Volvo Group in 2015. They announced the Polestar 1 in 2017 and the Polestar 2 in 2019. In 2019, they opened their Polestar production facility and by 2020 were making their first sales. As of 2022, the company is operating in select countries across Europe and the United States and Canada, but are expanding rapidly over the next 2 years across Europe, Asia and the Middle East. In terms of current production and sales, the numbers for Polestar are still quite low compared to Tesla and NIO, but they are rapidly improving and they are still miles ahead of most EV companies when it comes to sales. Polestar achieved sales of 29,000 vehicles in 2021, but achieved over 20,000 in the first 6 months of 2022 and have reaffirmed their sales guidance for the year of at least 50,000 by the end of 2022. Polestar continues to deliver on its market and retail expansion plans that underpin significant growth targets, where they are expecting to be operating in 30 markets by the end of next year and are expecting to ramp up sales to over 290,000 vehicles by the end of 2025, in which time they expect to have 3 more Polestar models on the market. So what do analysts think of Polestar? Looking at tip ranks, 2 analysts have set 12-month price targets for psny stock in the past 3 months. The average price target is $11.50 with a high forecast of 13 and a low forecast of 10. This average price target represents a 15% change from the last price of $9.94. And during the previous 2 years, 113 institutional investors and hedge funds held shares of Polestar, with institutional ownership currently around 29%, and Polestar is backed by Hollywood actor Leonardo DiCaprio and Geely Holdings, who are the company that owned Volvo. So in a world where many EV startups seem to have difficulty ramping up production, this should not be a problem for Polestar. The next company is Fisker. This stock is trading at a similar price to Polestar at only $9.64. But with a market cap of less than $3 billion, this is valued at only a fraction of what some other EV companies are currently trading at. Now, Fisker is different than nearly every other EV company out there. Their entire business model is different and they have a very interesting history. In 2007, Henrik Fisker founded the first Fisker company. They produced the world's first production luxury plug-in hybrid electric vehicles in 2008 that were first delivered in 2011. However, for several unfortunate reasons, production was suspended in 2012. However, Fisker was relaunched in 2016 and went public on the New York Stock Exchange through a merger with Spartan Energy Corp in October 2020. But who is Henrik Fisker? He is an acclaimed designer. Henrik Fisker designed several Aston Martin cars over the last decade. The V8 Vantage and the DB9 are both credited to him. And he has also brought in other Aston Martin personnel too. Fisker has adopted an asset-light business model where Fisker is bypassing large factory costs by doing contract manufacturing and bypassing the need to have a dealer network by doing direct sales. This makes them a very interesting investment. But there are pros and cons to this business model. On one hand, Fisker does not have to build a factory. On the other hand, they lose some margin because they are paying someone else to build their EVs. Fisker is just launching their first EV model, the Ocean SUV, which starts as low as $35,000 with production starting this year. And this will be built by Magna International, which is a giant global auto industry supplier. With the second Fisker model due to be built by Foxconn at the production facility that Foxconn have recently purchased from Lordstown Motors, Fisker hope to sell 250,000 vehicles out of the US production and then expand into Europe. So with a share price of less than $10 and a market cap of less than $3 billion, Fisker is not a large EV company and certainly not overvalued considering their financials and where they are in terms of nearing commercialization. But what do analysts think about Fisker? Looking at tip ranks, 8 Wall Street analysts have set price targets for Fisker in the last 3 months. The average price target is $15.86 with a high forecast of 28 and a low forecast of 10. The average price target represents a 71% change from the last price. Now there are very high barriers to entry into the EV sector, and any startups need to have strong financials. Fisker currently have over $800 million in cash and total assets of nearly $1.4 billion. Liabilities amount to $780 million, but this is largely made up of convertible notes, with current liabilities only $85 million, so this is a very strong balance sheet. Fisker is backed by several large institutions, with institutional ownership of over 28%. And during the previous 2 years, 230 institutional investors and hedge funds held shares of Fisker. So guys, what did you think of those first 2 stocks? I'm sure you are already aware of both of these companies, but drop a comment and let me know what you think for the future of these. And remember to hit the like button too. Next up is ARVL, ARVL on Nasdaq. This stock is trading near its all-time low at only $1.43 and a market cap of less than $1 billion. The stock is down over 95% from its all-time high back in 2020, and there are reasons for this, which I will discuss in a moment. Despite a market cap of less than $1 billion, this company is not small, considering a total workforce of over 2,000 people. ARVL is an EV company aiming to change the EV industry by betting on a different production approach through smaller automated factories. ARVL was founded in 2015 but only went public in 2020 through a SPAC merger. Shortly after the merger, ARVL reached a valuation of about $13 billion, but now it's worth less than $1 billion. What makes ARVL different is that ARVL is rethinking the production method using components, materials and robotics to produce its vehicles, eliminating legacy processes in its factories. While the auto industry is built on the idea of economies of scale, ARVL aims to produce its EVs in microfactories. These microfactories will be installed locally with a small footprint and a small cost of about $50 million per factory. ARVL's factories can be operational within 6 months, allowing the company to be very flexible on its growth plans. So ARVL's production processes are different than other EV companies, but they are also targeting a very specific part of the auto market and not targeting the passenger car market that most EV companies are looking at. Instead, ARVL are focusing its product offerings in the lightweight commercial segment through 3 vehicles: a van, a bus. The plan for the car was that in time, it could potentially be offered for robo-taxi services or ride-sharing platforms, but the company have recently put these plans on hold and also cut hundreds of jobs in order to preserve funds ahead of the scheduled production start of its electric van this year. The company has also just announced plans for a share offering to the tune of up to $300 million. This has led to a sharp decline in the share price, but ultimately this is a good idea. There is no point risking bankruptcy, operating on too many fronts at once with no income. These planned vehicles could be revived once the company is generating revenue, and the extra $300 million will provide enough cash for the next 2 years. Looking at the recent earnings slides, we can see that ARVL posted a loss of $90 million for Q2, but had over $500 million cash at the end of the quarter. This loss is bigger than previous quarters as the company begins production, but cost-saving measures should also help the company going forward. Looking at market beat, we can see that ARVL is currently at rock bottom of its 50-day range and 52-week range, while the average analyst price target is $11.50. The most recent of these was set by Barclays, where they slashed the price target to $6, but even this is several %100 above the current price. ARVL is backed by several large institutions with ownership of around 10%. And during the previous 2 years, 85 institutional investors and hedge funds held shares of ARVL. The next EV company is not targeting the commercial passenger car market that most EV companies are looking at. Nikola is an EV company traded on Nasdaq with the ticker NKLA. Now, this is definitely a risky choice, and there are lots of other things that I could talk about from the negative side when it comes to Nikola over the past few years. This is a company, after all, that Hindenburg Research released a short seller report calling Nikola an intricate fraud. Nikola had lied to investors and released a video of a Nikola truck cruising along the road, but in reality, this was a truck rolling down a hill. The stock had traded as high as $90 back in 2020, but has now fallen to just $6.80. And for this, Nikola was heavily penalized, and its founder and CEO from the time is currently subject to criminal fraud charges and will go on trial later this year. But on a positive side, Nikola is now the first company to get its BEV Class 8 truck into volume production and is guiding between 300 to 500 truck deliveries this year. Nikola intends to manufacture both battery and fuel cell electric vehicle trucks in the US and Europe. It has a plan to build the trucks and the fueling infrastructure for both types of vehicles and has signed MOUs with industry leaders to help make its vision a reality. These include such partnerships with world leaders Iveco and the development of the Nikola tree. Then there is also the agreement with Opel Fuels and the recent acquisition of Romeo Power. I think that there might be a great opportunity now at Nikola, but it might still be a little too high of a price. The current price of $6.83, but I think if this was to drop anything below $6, there could be significant value to be had. But what do analysts think of Nikola? Looking at market beat, we can see that Nikola has recovered well in the past 50 days, but is still very low over the 52-week range. Remember that this stock did trade as high as $90 in the past, while the average analyst price target is now $11, so there is clear upside here. The most recent of these was set by Cowen just this week, where they dropped their price target to $12.50, which is still a 100% upside. And Nikola has got serious institutional backing with ownership of nearly 50%. And during the previous 2 years, 239 institutional investors and hedge funds held shares of Nikola. Looking at the most recent financial statements released last week, we can see that the company had total assets of $1.1 billion, which includes over $440 million in cash. They have total liabilities of $560 million, but current liabilities are only about $250 million. Losses for the first 6 months of the year add up to over $300 million, so the company still has a long way to go before ever becoming profitable, and they will probably need to do a share offering to raise additional funds. But in my opinion, this is definitely a company worth keeping on your watch list. Before I give you a quick conclusion, what do you think of these stocks and which one do you think has the most upside potential? Drop a comment and let me know what you think, and remember to smash the like button and subscribe to the channel if you're new. For my conclusion, I think that each of these stocks has their own unique advantages and offers a lot of future upside. In the world of passenger vehicles, I believe that Polestar is best placed to become a major player in the market and is still far ahead of most EV companies. However, at only a fraction of the price, with plans to expand their sales to somewhat equal to Polestar within the next few years, Fisker certainly looks like great value. On the commercial side, both Arrival and Nikola are risky investments, but at their current beatdown prices, there is a lot of upside potential here too. Remember that both of these stocks are trading at a tiny fraction of their past valuations. If they can make it through this period of uncertainty, then these companies could have very big futures. Remember guys, that I am not a financial advisor and this is just my opinion and not financial advice. If you enjoyed this video, like and subscribe, follow me on Twitter, and I'll catch you in the next one.